You'll recall that in the last lecture, I showed you a screen which looked like this, which is when you log on to an online brokerage, and in future lectures, I'll show you how you pick a good brokerage and how you become very comfortable with the trading platform. That's all yet to come. So what does this look like? What is this screen that we're buying and selling? These are actually buttons you can click on when you go onto an online brokerage. So if you click on the buy button, you will be buying. When you click on the sell button, you'll be selling. Now, let me just give you a brief introduction of what this percentage in point or pips means. And it is this. We are looking here at Australian dollar, US dollar. Okay. And this is the quote for it. You'll notice there's a sell and a buy price. I'll explain that in a second. The pips are done this way. The big number, the 1, okay, let's just zoom in for a second. The big number, the number 1, is the $1. The 2 cents is the next 2 digits. Well, you're used to that. You're used to saying $1 and 2 cents, aren't you? The pips are these numbers then which follow. In this case, it happens to be 44, which actually is 44 100ths of a cent. Hence, it's called a pip. It's so small. So it's 100ths of a cent. In a way, you don't need to be worried about this too much. And then the small number again becomes 2/10 of a pip. Now, on the whole, we tend to ignore this, the 2/10 of a pip. It's just a little thing that many brokers have started showing and offering. It really is irrelevant. And the reason we ignore the $1 and the 2 cent part as well, and why it's in small numbers, is because it hardly ever moves. It takes a long time for it to move. The real numbers we're trading off are the pips, 44, 41. You can see there's a 3 pip difference between those two numbers. Now, what we're looking to buy, if we buy at 44 and sell at 41, we've obviously lost 3. 3 what? 3 pips. What's a pip? It's 1/100th of a cent. So we've lost 300ths of a cent. Well, what's that in real money? We'll come to that in due course. But the point with all of these is we're buying at one price, selling at the other. And we need to know when we think the price is going to move. We need to know some jargon, which is going to come in future lectures. But at this stage, I just wanted to give you the introduction on this part. Let's just add some more jargon while we're at it. The difference between the buy and the sell price is called the spread. It's called the spread. What's the buy and sell price? Well, the other names for them is the ask price and the bid price. Okay, and the difference between the bid ask is, as I say, the spread. And in this case, the spread is 2 pips and 1/10 of a pip, or 2.1 pips. Now, I tend to run through this material relatively quickly. The reason is, the great thing about doing online video courses is you can pause and look at this and everything that I've said and make notes. Because when you come to refresh yourself, you don't want me to going really slowly and then you've got to forward through it. So don't worry about pausing this and having a look at this and getting to understand some of the jargon. Once you get used to it, then screens such as this next one will become second nature, which is an online trading, typical online trading screen with all the major currencies on there. You've got euro, dollar, you've got euro, as well as euro, dollar, you've got dollar, Japanese yen, you've got sterling against the dollar. And you can see there's 2 numbers, a buy and a sell price next to each. Now, if you were to just buy and sell on any of these, you'd make a loss. What you need to do is buy, let's say at 22, and then sell when that hits maybe 23. That way you'll have made a pip. How much is that pip going to be worth? We've got to do that calculation as we go on, and we will, and I'll show you how you do that calculation, but that's a little bit later on. All I want to show you for the moment is we're going to be buying at one price, maybe at 22, selling at the other price. Hopefully not at 21 because that's a loss, but at 23 instead. Okay, how do we find this screen? Well, we found a good broker and we logged on. We'll teach you all of that as we go on. The things which then come to mind are, well, what are the kind of time frames people look at? There's, as you would expect, 3 time frames: the short term, the long term, the medium term. Each sort of feeds into another. What do they mean? Well, they mean this. Basically, and this is a chart here, which is the long-term chart. It's a long-term chart of euro dollar, okay, the euro dollar over a number of years, and each one of these bars represents a month, of price movements. And you can see the price here in the euro dollar. And you can see this lovely little trend where what's actually happened is the price has moved in this nice little upward direction. And as I say, each one of these bars has moved over each month to represent price moves. That's all straightforward. Well, that's the long term. What's the medium term? The medium term, this is each one of these bars is 1 day, and this is spread over a year. So the time frame is down here. It's spread over a year. The prices are up here, and it is, again, the euro dollar over a year. And over a year, you can see how, again, the euro dollar just moves lovely in one direction. You could see how somebody could profit. They place a trade at the start of the year, and by the end of the year, if it's gone in their direction, they've made a lot of money. That's still not how we trade. It's not how foreign exchange traders trade. They don't place one trade a year, as you can imagine. What they do is they'll probably trade closer to this, which is a short term. 4 hours is each one of these little bars. Each one of these red and blue bars represents 4 hours. It's again euro dollar. And I'll explain all these charts in forthcoming lectures, of course. And you can see what, in actual fact, the trader is trying to do is get in at the right point as the price rises, get out as it falls. Now, this is just 40 days. But you can see over 40 days, there are lots of opportunities to make profits. There's been lots of opportunities in which you might have made losses. So if that's the short term, which is just 4-hour charts over 40 days, and there's lots of trading, how often do we trade? Well, let me show you a chart of the number of trades I once placed. This is 454 trades. So here what you see is the number of the trades. By the way, the extra numbers are charges, and I'll explain charges in due course in future lectures. It was done over a 2-week period. There actually happened to be 450 winning trades and only 4 losing trades. And what I've written down here is the value of the wins and the losses. You can see there was one big win coming in slightly over 500. And on the losses, there weren't many. There were only 4. But you can see the number of trades. That's typical of a very active trader. You don't have to do that many. You don't need to trade that actively. But people often ask me, well, over 2 weeks doing 454 trades is not abnormal for an active trader. Lots of opportunities to profit, as you can see. Some opportunities where you might make losses. So I wanted to give you an idea of what it means when we actually say that trading is long-term, medium-term, short-term. The next thing we need to know is, okay, well, how do we access this market? How do we do this? And I'll do that in the next lecture.